Hey folks, Dan Frio here with your market update for October 25th, 2024. So we saw mortgage rates ease a little bit yesterday. I don't know if you caught me on News Nation, but I was on there yesterday kind of giving it a discussion or my advice on what happened to house prices this year and what the expectations are for next year. So I'll put that video right up here. Check it out. I was actually on TV yesterday. So without further ado, we're going to look at today's economic news. There isn't really much there. And then we're going to take a deeper dive into the bond market, because if you guys don't really understand how mortgage rates work, they work off of a bond. So let's get over to the news that we have so far. The economic calendar for today is basically durable goods orders. Core durable goods orders month over month, they were expected to come in at the last reading was 0.6. The new reading was supposed to be a negative 0.1, but it actually came in at 0.4. But if you look at that's the core. If you look at just durable goods in general, last reading was negative 0.8 and it stayed right at negative 0.8. Michigan inflation numbers ran at, the last reading was 2.9, came in at 2.7. So nothing else down here really is going to tickle your fancy. So let's get over to the real news that we're seeing right now. What in the world is going on with bond rates? Because they affect this right here. This right here is the mortgage rates, and these are controlled by mortgage bonds. So we're trying to figure out what's going on in the bond market. I'm confused. Analysts are confused. Maybe this guy can give us a little bit of tidbits on what's going on in the bond market. So let's let him take it away. And what he's going to talk about is issuance and bond yields and the Fed. When we come back, I'm going to show you kind of adding fuel to this fire, where we're not the only country issuing a lot of debt. There's countries all over the world issuing a lot of debt, and that's what's mainly causing this bond yield to go up. So I don't know if you understand that part of it, but let's get to the interview right through here. I'll be right back to explain all this stuff and put it in kind of layman's terms for you. So let's take it away.
Treasury yields, they have been rising, but the 10-year yield pulled back yesterday from its 3-month highs. Join us right now. Try to make sense of what's going on here. Jim Caron from Morgan Stanley Investment Management. You're looking at the 10-year right now at 4.2. You're looking at the 2-year at 4. We'll call it 4 flat. Jim, what do you think's really going on here, and how much control does the Fed have anymore?
Well, it's a good question, and good morning. Look, I think there were a lot of competing narratives that are out there. One is that, the data got better since the Fed cut interest rates. We've had a higher movement in gross domestic incomes, which shows that the consumer's stronger. Retail sales corroborates that. We've had a rise in the CPI that was a little bit surprising. So some of the inflation data isn't necessarily cooperating. And there's also the commentary that goes around the Trump trade, right? Tariffs and more expansionary deficit policies and all of these things together. So it's really not any one thing. There's definitely competing narratives that are out there, but we also have to recognize that people did buy a lot of fixed income when the Fed cut interest rates, and people got very long and they got disappointed and they've had to sell. So there's also technical factors at work too. So I can't assign any one thing to the to the explanation for higher yields. It's a combination.
I don't know if you saw Paul Tudor Jones earlier this week. He said he would stay away from all of this, meaning he said commodities great, you want the NASDAQ great, gold, Bitcoin, but the stuff we're talking about, not for him.
Well, look, I have a lot of sympathy for that, because essentially what I think he's saying, and the way that I'm looking at this as well, is I think that bond yields, generally speaking, are just in a trendless range. They're just going to move sideways over a period of time. It's going to be dictated and governed by what Fed policy is, and the Fed is expected to cut rates. So this movement higher in yields is likely to be contained at some level. But in reality, if you're trading in the markets, if you're trying to, have an allocation to bonds, you have to ask yourself, what am I trying to capture? And really all you're trying to capture right now is just the coupon. It's just the yield. You're not really going to get a directional push or what we call the duration component of returns to contribute, because I think that in reality, a lot of the movement is priced just based on Fed policy expectations.
Perfect. So what he's basically saying is a lot of investors jumped into the market and bought up bonds prior to the Fed cut, and then the Fed cut a little bit more than they expected, and then they were in a position of selling their positions. So a lot of sales of bonds took place at that point. So other things right through here, let's look at durable goods manufacturing numbers. They came in today, and they're not looking good. If you look at every one of these segments, the number of orders here, there was a thing. Subtraction, where is it? Manufacturing is much smaller economically. There was a thing in here, and it went basically line by line by line telling us what the durable goods orders are looking like. So let's go over to this chart. This chart's going to give us a little more. This is basically right from the publication. So you can see the durable goods orders are down. But here's the concerning part of this, and this is the manufacturing component of our country. New orders down 3 of the last 4 months. Shipments down 2 consecutive months. You go down through here, unfilled orders up 49 of the last 50 months. Inventory down. So things are getting depleted, but the manufacturing piece is not catching up with that. So that tells us maybe the consumer's slowing down a little bit there. So now let's get to the national debt stuff that we have. So this, I know it probably drives you crazy when I got to keep bringing this up. We're almost $36 trillion on our national debt. So what I want to explain in this part of it is how mortgage rates and everything work. Okay, they're a function of the bond market. Okay, so what happens is investors have the opportunity to buy bonds. They can buy government bonds, they can buy corporate bonds, and they can buy mortgage bonds. So what's happening right now, our government is issuing more bonds than they ever have in history. That's thus the federal deficit at 35 coming on 36 trillion. But so that we have that debt hitting the markets. Then what we have is corporate debt hitting the markets because, commercial debt, it matures and things like that. But what a lot of people don't realize, too, is we're not just the only country competing for investor dollars. So you have countries right through here. It says the World Bank is now gearing up to launch a lot of debt. Then you go over to China. China's just issued $1 trillion in yen in special bonds. Then you go over to Japan. Japan's issuing long-term debts. So you have all this debt load coming to the market. So what investors are going to do, they're just going to sit there and they're going to say, okay, which one of these have the highest quality? And most of them are going to pick the U.S. debt in most cases. And they're going to say, okay, what's my yield on that thing? Because I'm going to try to weigh my options on risk versus reward. So the higher the risk you take, the higher the yield you're willing to take. So if you look at a government bond, which has 0% risk, and you have a corporate bond, which has risk, and then you have a mortgage bond that has risk, okay? So unless the mortgage bond's yield is high enough above the Treasury, which has no default ratio, that's where your risk premium comes in. How big of a risk premium is there? Well, that's the disconnect right now, because the bond investors are sitting there saying, well, I can capture a U.S. government bond at 4 or 5%, which is fantastic. So why would I want a 5% bond for mortgages? I don't really want to take that much risk. That's what we're seeing in the markets right now. That, like what the other gentleman said, maybe the Trump trade might be changing some dynamics and everything else. So over the next couple weeks up to the election and after the Federal Reserve does whatever they're going to do at the next meeting, I'm going to show you what the CME is looking like. That's when hopefully the markets start to settle. But the good news today is based on whatever information's out today, the CME is telling us it's almost 100% chance at this point that the Federal Reserve is going to cut rates. So right now, the CME FedWatch tool is telling us there's a 97.3%. That's basically as high as it's been over the last couple weeks or so. So we're pretty certain the Federal Reserve is going to cut rates by 0.25%, and we're going to see how everything moves from there. So what do I do? How do I do things? Well, my name is Dan Frio. What I try to do here is educate you guys on basically everything I can. So I'm in the mortgage business. I'd love to help you navigate the mortgage industry, but I also want to teach you guys, how to save money. Because a lot of times what I hear from people is like, Dan, I'd love to buy a house. I just have no money. I'm like, okay, well, how much are you putting away each month? Or like whatever I can or whatever. You need a budget. Okay, so we're going to start helping you guys with budgets, but we're also going to start talking about stocks. So you can check out Stock Talks with Dan, and I'm going to do that every Tuesday to talk to you guys about, a portfolio that we created. And I want your feedback. I truly want your feedback. What do you want me to talk about? So next week, what we're going to talk about is our ETFs. ETFs are probably the investment I would recommend mostly for first-time investors. So we're going to talk about those, why, you would invest in those, what areas can you invest? And we're going to do a lot of things on Tuesday talking about ETFs. But if you need help with a mortgage, okay, my name is Dan Frio. Like I said, you can check me out at the Rate Update. Here's my website. You can check out all kind of blogs at the top. But if you're looking to buy that first house, I'm in the Chicagoland area, so if you're near me, check out our grant finder right up through here. It'll give you grants in the Chicagoland area that you might qualify for. This will give you $10,000 to use for down payment and maybe down payment assistance. But if you're anywhere else out in the country, check out the National Grant Finder. There's 3 grants in here that we hand chose because they're as close to free money as you can get. There's no ramifications, and it'll give you money to help you, again, with the down payment and maybe those closing costs. And maybe you might even have to pay your realtor now, so you might even use a little bit of those funds to pay your realtor. But you're going to find out all kind of information here. But if you want to kick the tires to see if you can get qualified to buy that first house, maybe buy that first investment property, maybe even refinance, check out, you can click right through here, the Apply Now button, or just give us a call. You just scroll down to the bottom. This is the best, quickest, easiest, and fastest way to do this. There's 3 of us here. There's going to be 3 of us answering the phone. Well, not at the same time, but it's going to be me, David, or Alan. We all have over 20 years experience doing this, and our whole goal here is just to help educate you and guide you basically from application to keys in your hands. So check us out. Here's our phone number and my email address. Have a fantastic day, and I'll see you at the closing bell to see how all this mess ended up for the day. Take care, folks. See you then. Bye-bye.